Welcome to the deep dive video update. This is a weekly video that I do where I have to explain this. I look a little deeper inside of some of the charts that maybe I didn't use that much throughout the past week. And the reason why I call it the deep dive video is because we have to analyze these more in depth to see if we're getting any information from these particular charts. And this is being prepared for Monday, December 15th. Before I get into that, from now until the end of December, I have a program called the SPX Investing Program. It's free. All you need is an email address if that's of interest to you to check it out and see if it's a program that will benefit you. Okay, so the first chart that we're looking at is the Ulcer Index. This is another sentiment gauge, and I was using this very heavily when we were going down in November. The Ulcer Index, okay? When it's going up, that means you're probably getting an ulcer. These are for usually mutual funds and those things that only have one price at the end of the day, a net asset value, and you're pretty much long in that. So you're only benefiting if the market's going up. Well, if this indicator is going up, that probably means you're more stressful. And it did drop down when we started to come down the week of Thanksgiving. And so far in December, we're seeing fear coming out of the market, according to this chart. And so I only show it when it's above the red line, which is the moving average. And since we're below that, I haven't been showing this chart. Another thing that I look at that I use just in this particular video, it's a long-term range of the VIX. Just to get an idea, and we're still below 20 overall. We're still below 20 on the daily side too. And typically, when the market is more positive, the VIX will be under 20. When we're in a bear market and we're really going down, the VIX will go up into a higher range. And since we've been coming up recently, we just set an all-time high with the S&P on Thursday, although Friday wasn't all that good of a day. This is still going down overall, and that's more positive. But we don't really look at the little tiny moves. We're just looking at the general range overall. And when we were coming back up here, when the market was really going down, we didn't get above 20. And then since we came up out of the lows last spring, this, for the most part, has been going down and then getting a little choppy lately. This also measures the momentum of the VIX. Just keep an eye on this. Sometimes I use this chart a lot. Lately, I haven't been using it all that much. And this is the MACD, which is a momentum oscillator. And when this is going up, that means the VIX is going up. Not really hard to see that. When this is going down, that means the VIX is generally going down. And that's what we've been seeing lately. We did go above 20 there for a while back in November when the market was under some pressure. And since we've been coming back up, the VIX has been dropping. And we can see that just by looking at the overall chart. So I use this when it's like, okay, what's really happening here? Especially if we see a contradiction where the VIX might be going down, but the MACD is still going up, that kind of a thing. Then we also want to know the speed of the VIX. This is an RSI, Relative Strength Index, based on 9 periods. That's short term. And I only use this chart if we go above the 70 level or below the 30 level here. That just shows that we're going pretty quick. And a lot of times when we see really fast moves with the VIX, they tend to exhaust themselves pretty quickly. Well, right now, we're not at any extreme reading, so there's no need to show this chart. Another study of the VIX is the VIX to S&P correlation. I use this in the daily videos. If we get above this dashed line, that means the market is getting kind of nervous. Now, the benefit of this is sometimes we're picking up fear in this chart that we're not getting in other charts. And there was a time back in October when we were getting a really high reading, but you wouldn't have known that by looking at the VIX or looking at some other sentiment gauges that we follow. But this was picking that up. And so it's like, okay, let's be aware here. And then we had a big down day. This dropped. It's since that time been giving us a pretty low reading, so there's no need to show this in the video. And we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the MOVE index. And in this context, we have been coming down, and that tends to be positive. Now, there are times when this red line's going up and the S&P can go up as well. So it doesn't mean that one direction is better than the other. But when we were really coming up out of the lows last April, this line was going down with a little bit more conviction. And we were still going up here, but we were a little bit concerned while the red line was going up. Now we're starting to roll over again. If this continues to drop in this particular context, we would treat that as positive. And then we look at a, a ratio here between the VIX and then the VVIX, which is the volatility of the VIX. It's like how fast is the VIX itself moving, similar to what I do with the RSI. Well, then I place a 50 period moving average on top of that. And in a general sense, when this is going up, that usually means stocks are going down. And when this is going down, that usually means stocks are going up. And we were coming back up here, even though the S&P was still going up. And then we had that big downward move last spring. Well, since that time, we've been going up with this 50 period moving average, but lately we've been rolling over, and that should be taken as a bit more positive. And we look at the ratio between large caps and small caps. Now, when this ratio is going up, that means the large caps are outperforming. When this is going down, that means the small caps are outperforming. And we're seeing a little bit of a shift now. It's going down, but it's not really breaking out of this range that it's been in. We're seeing a possibly a character change, at least for right now. It may change once we get into 2026, but we're seeing small caps doing a little bit better. The Russell 2000 set an all-time high this past week. We're not quite there yet with the S&P 600, and this is probably the most popular small cap index, the Russell 2000. We compare that to the Russell 1000, which would be like the S&P 500, and then just do a straight ratio between the two. And as this is going down, that means the large caps are underperforming. Or to say it another way, the small caps are outperforming. We'll keep an eye on this and see if this tends to lead to anything because we've seen things like this before. The bigger picture is that the large caps have been outperforming the small caps. If we're shifting over into a different character, then we would continue to see this go down, and we'll just make note of that. All right. And then from a percentage basis, where are we as of Friday's close from the October 2022 low, the October 2023 low, and the April 7th, 2025 low? And this just measures, I have a spreadsheet that calculates this and just shows us where we are on a percentage basis. And this also looks at the percentages here and not really getting all that much. I was watching this when we were coming down back in November. We hit an all-time high, then we were declining, and we fell about 5.6%. And then we bounced back up from that. Now, you wouldn't have known that by the perma bears were dancing on the grave of the market. Everybody was screaming bloody murder. Everybody saying the market's overvalued. We're worried about the AI trade. Well, then we kind of got over that, and we've been going back up, and we did set a closing high with the S&P on Thursday. So that's what I watch when we're going in the opposite direction. And then these other measurements are just similar to what I just showed on the previous chart. How far have we gone up when we hit some kind of significant low to where we're at right now? And we keep an eye on different advanced decline lines. This one is based on the S&P. It's a cumulative advanced decline line based on price. And this is pretty good. We're setting a new all-time high here based on price and volume. That's positive. Now we ticked down a little bit because Friday was a down day. We were down a little bit over 1% with the S&P, but we set that all-time high on Thursday. So this is still holding up quite well. And we look at the broader market, the cumulative advanced decline line for the NYSE. It did set a recent all-time high, and then we're pulling back just a little bit. And then on the bottom, we have what's considered to be a regular advanced decline line. It's calculated in a different way. It's coming off of just setting an all-time high. And then here, this is a different regular advanced decline line, but then again, calculated in an even little different way, just coming off of a recent high. So internally, whether you look at the broad market on the NYSE or the S&P, we're looking pretty solid from this perspective. Then we just look at common stock on the NYSE here, just coming off of an all-time high based on price as well as volume. That shows a pretty healthy market. And then we do an apples to oranges comparison, the S&P to the NYSE advanced decline line. And the red line's a little bit above the bar chart. Now they're on completely different scales here. And the moving averages that you see, they're plotted against the red line here, just to see, okay, we're in an uptrend. That's more positive for the market. But we're seeing the large caps really slow down, the mega caps, the stocks that have really been driving the indexes. That's why we've been chopping along, kind of going sideways a lot lately. And there's concern over the AI trade. The companies are spending all this money. It's like, what are they going to get for that down the road? Is this just money that's going to go flying out the door and not come back? And so we're seeing the broader market holding up just a little bit better than the S&P, because the S&P is a weighted index. And so if the big stocks are up or down, they have more of an impact on the index. And then this is still looking pretty positive, not quite as positive as we were, but this is longer term. This is a 10-day average of the highs and lows for the S&P. We were able to get above this green line, and that's positive. And especially when we can stay up here for a while, that just shows stronger, longer term upward momentum. Now we are dropping down a little bit. We're still coming in at a pretty high reading here. So, I mean, this is still looking okay, but it is down just a little bit from when I had shown this chart before. We do a similar thing here. We look at a 5-period moving average of the highs and lows on the Amex, NASDAQ, and NYSE, and we're still above zero and going up. And this is continuing to go up. Now, this is a little shorter term. The previous one was based on 10 days. This is based on 5 days. But this also shows that the broader market is holding up a little bit longer term. Okay, then we look at a ratio of US to international stocks. Not really doing much here, just kind of floating along sideways. And then momentum stocks, which is kind of interesting here. And we were really coming down in September and into October. And then this was actually doing better as we were going down in November, and it was still going up until a few days ago. And then it really started to roll over. So we're going to keep an eye on this. If this continues to go down, that could mean that the momentum stocks are losing some steam on a ratio basis when we compare it to the S&P. Then stockcharts.com has technical alerts, and if they're red, they're negative. If they're green, they're positive. The bottom one is from Monday. The last one on the top is on Friday, and we can just kind of tell at a glance by looking at the color. See, Friday was a down day. You see lots of red. We had some up days along the way here. Thursday, that was a pretty good day, so we see lots of green. Now, I go through all of the alerts in the daily videos. I don't spend a lot of time on them. I just kind of go through them quickly. But this just gives us an idea of where we're looking from a positive or negative perspective. And then we rank, excuse me, I don't want to go back and start this recording again. We rank indexes on what are called technical scores. The higher the score, the better looking from a technical analysis perspective. First place, small caps coming in at 92.2. Now, this is the time of year. We've seen this over the last couple of years, 2023, 2024. Right now, as of 2025, it seems to be happening again, where the small caps are seeing some favor. And this is the IWM, which is the ETF for the small cap index, which is the Russell 2000. And this is looking pretty good. And they like that interest rates are being lowered by the Fed. And that's what happened this past week. And they're coming in first place at 92.2. Then we have the NASDAQ itself. This is the bigger NASDAQ composite. And that's in second place. Even though it dropped down a little bit here, it's still looking pretty strong at 83.2. Then we have the Dow, which is in third place, which is only 30 stocks, and it set an all-time high this past week. It's improving from a technical perspective, also coming in at 83. Then we have the QQQs. Now, these are the big growth stocks that make up the NASDAQ, which we call the NASDAQ 100. You can see how this is coming down. And we don't want to see this. We want to see this going up. When the market is really strong, the QQQs tend to lead things. And that's not what we're seeing right now. It's not like it's negative. It's just not showing the strength that we have seen before. And it's coming in at 72.1. Then we have the S&P also coming in at 72.1, drifting down a little bit after it had a bit of a higher reading. Now, where the NASDAQ 100 is all growth, the S&P is growth and value. So it tends to not go up as fast when we're really moving up with tech and growth, but it tends to not go down as much when we're facing a decline. It tends to hold up better because of the balance within the index itself. But it's coming in at 72.1. Then the mid caps, which are still the worst performing index, but they're improving. They're above 50 and they got up to 67.3. They were actually up into the 70s after Thursday, but then they pulled back a bit on Friday. But this is still one of the weaker indexes that we've been following for quite some time. Then a short-term rainbow going from 10 periods up to 50 periods using simple moving averages. We're still above the rainbow here, and the lines are starting to go back up. That's showing that the short-term trend is still sticking to being positive for right now. Then we look at a short-term advanced decline ratio. We're above zero and going up based on price. We're also above zero and going up based on volume. That is positive. And we're still well above these anchored weighted moving averages. It held as a support level, which was right around the 100-day moving average. And we saw a convergence there where this was coming down. It hit this support level, it hit the 100-day moving average support level, and then bounced up from that. And since we're above all these anchored moving averages, there's been no need to show this in the videos. And then we measure the distance away from various moving averages, the 20 short term, 50 intermediate term, 200 long term. When we get too far away from a moving average, price will have a tendency to snap back to that moving average. And we're not too far away right now. We've been chopping a lot sideways lately. Then an intermediate term rainbow starting at 50 periods, going up to 100 periods with simple moving averages. And even though we came all the way down to the bottom part of the rainbow, that's the 100 period moving average, and then bounced up out of that. That happened pretty quickly. And so these lines still, they're going up and showing that the intermediate term trend still remains positive and is strong. And then we look at the 50 period moving average. Now I'm following the 20 period moving average because we came down and tested that in Friday's session. And so far in the short term, that support level is holding. If we break below the 50, the next one that I follow, excuse me, if we break below the 20, the next one that I follow is the 50. This is the intermediate term trend, and prices above both. The lines are still going up. We are positive. If we break below the 50, the next level would be the 100 period moving averages, and see how we came right back down here in November and then bounced up from that level. So we don't watch this on a day in day out basis, only when they seem to start to come into play with what's actually happening. And then the Connors RSI, I only pay attention to this mostly when we get an extreme positive or negative reading, which we're not getting right now. And then the Landry Light, it seems to be trying to give us a positive trend here. It was a positive trend there for quite a while. Then it was just not really sure what to do through most of the month of November. Now it's starting to go back up. And then the proper order, also a little mixed up here as we worked our way through November and the early part of December. Now it's starting to give us back a positive trend here. And the percent B indicator, this comes into play when we close above or below the upper or lower Bollinger Band. We're not there now. We are positive since we're above the midpoint of the Bollinger Bands. And then standard deviation, for a while, we were really moving around all over the place. This doesn't measure direction, it measures speed over the last 10 periods. And we really dropped down here as the market just went into a sideways phase. But when this goes above the moving average, similar to the Ulcer Index that I showed a while ago, I only show this when we're above the moving average and we are currently down below it. And another momentum oscillator looking for extreme positive or negative readings, CMB composite. When we were going up there the week of Thanksgiving in the first part of December, this was giving us an extreme reading. And then we started to come down as the market ended up going sideways for a while. The mass index is not generating a signal. We pay attention to this mostly when we get up to the red dash line and the blue line, but we're going in the opposite direction right now. And not enough movement here, even though we set an all-time high on Thursday, not enough to draw in any new X's. You notice there's an X from back in October. That was an intraday all-time high. The high that we set on Thursday was a closing high, and we didn't get up to give us another new X there. So on an intraday basis, we're not at an all-time high, but we did set it on a closing high. And we keep an eye on the S&P 100, which lately has been starting to underperform the S&P 500. Now, you can't tell that by this chart. These are just the indexes themselves, and we're not really seeing anything out of line all that much. But we want the S&P 100 to outperform the S&P 500, since the S&P 100 are the biggest stocks that make up the S&P 500, and they have been, in the very short term, underperforming. Then another long-term rainbow starting at 50 periods, going up to 250 periods. We came down into the rainbow, got out of there quickly. The lines are still going up. Long-term trend is still positive. A long-term oscillator called the special K. This is the daily chart above the red line. The red line starting to go back up. That is long-term positive. Now, this is not really official. This is a monthly chart, but I wanted to show this because when we're light blue and going up, that's positive with the TTM squeeze. When it turns to darker blue, that's negative. Now, we still are not even halfway through December, so this can change back over. I just wanted to show it right now, saying that, okay, it's picking up a little bit of the weakness that we saw in Friday session and a little bit of the lack of movement that we've been seeing lately. And so if we do go up and have an up move here from here on out for the rest of December, this will probably turn the lighter shade of blue and then be more positive. Then we look at a weekly chart of the S&P, a weekly chart of the German DAX, and see that we're pretty much neutral when we look at the correlation between US stocks and German stocks. And then a support and resistance area. This is the Ichimoku cloud. Sometimes I call it the itchy and scratchy cloud. We came all the way down to the lower end of the cloud, and then that held, and now we are still above the cloud. We're getting a little bit close to it now after Friday's decline. We'll have to see if that turns in to something. So this is considered to be a support area. And then we also have some trending areas on this chart too. The green line, that's short term. And then the blue, that's intermediate term, and the red line is red. Excuse me, it's long term. That's the long term trend here. And we are seeing a general improvement with this overall chart. And then we look at the VIXN, which is the volatility of the NASDAQ 100. It picked up a bit in Friday's session since the NASDAQ 100 was down. It was also down on Thursday, even though we set an all-time high with the S&P. But we're not seeing anything all that drastic right now. And then we look at the S&P on top, and this is a growth to value ratio, the Qs, the NASDAQ 100 to diamonds, the Dow, and we're neutral at this point. We were seeing that they were actually going in opposite directions there for a while, but now they're starting to work their way back up. So we're not really getting a lot of insight from this. Now, if we come back up here and we see a high correlation and the S&P is still going up, yeah, that'll tell us something. That would mean that growth is outperforming value again. So we're a little bit concerned here that we're not picking up a high correlation, even though the S&P has been holding up fairly well other than Friday's session. And then the transports are coming on strong too. And this might be something that we're seeing a change of character with the market. That's the red line. And a lot of times when the market is stronger, we see the red line above the black line, even though they're on different scales here. But the transports have really been lagging behind for quite a while. And now maybe they're starting to come more in favor. Bank ETF, just coming off of a recent all-time high here. That's good. We want this area to do well. That means the banks are doing pretty good. And we're coming up here. When we look at the ratio between regional banks, smaller banks, and the financial sector. Now, the financial sector had a good day on Friday, but it's got a lot of making up to do to start outperforming the S&P. But we do like that this ratio is going up because we don't want any of these bank problems out there. You know, Silicon Valley Bank, Republic Bank, New York Community Bank. And this is showing that there's a little bit more confidence with the smaller banks when compared to the financial sector. Another way we look at the financial sector is ARK, FinTech. That's an ETF. We did fall a little bit below the 200-day moving average, and now we're staying above that. But we're still below the 200-day moving average when we look at the FinTech ETF with the S&P. We want this to go up. We want this to improve. And it's looking a little better, but we need to see more follow through with this to have more confidence in the financial sector. Not really getting much here when we look at energy to 7 to 10 year bonds, just kind of moseying along sideways. And then I pointed this out a week or so ago when I did this video last time, is this is the value line geometric index. It set its all-time high in late 2021. And then even though we've been coming back up with the Dow, the S&P, the NASDAQ 100, we have not made another new high with this particular index, which is a longer term negative divergence. That might be starting to change. We came up to this trend line and we're trying to break a little bit above that. If this can keep going up, that means that more stocks are actually participating. One reason why we're not making a series of new highs with the value line here is because it was a smaller group of stocks, the mega caps that were really driving things. If this does continue to go up, that would be more positive, but it's also showing that more stocks are participating in the upward move. But we're kind of at an inflection point now to see if we can break above this resistance level. Then gold to the S&P, a little bit above this resistance level. I connected this top back in 2016 and again in 2000 or 2020, and we peak our head a little bit above that and then fall back. Peak above it, fall back. Well, we're back above it again. And when this is going up, that just means gold is outperforming the S&P. And emerging markets, seeing a little bit of weakness here when we compare it to developed markets. Now, developed markets would be the US and Europe. Emerging markets would be like markets in Asia and some of the smaller markets there. And this was in a range for a while, but we've been seeing this coming down. about halfway through November, a little later in November, we saw a breakdown here with this overall ratio because a lot of folks they want to get into emerging markets, and this might be the time of year when they want to do that. Well, this might throw up a little bit of a warning flag right now saying, wait a minute, why would you want to get into this? The emerging markets are underperforming the developed markets right now. Then we look at the US 10-year yield, subtract the German 10-year yield. We compare that to the US dollar index, neutral right now. Not really getting any insight from this chart. The German DAX is kind of going along sideways. We fall a little bit below the 200-day moving average. It's bouncing back up here. It's trying to get to its 50-day moving average, but it was really coming up solid here. It's had a pretty good 2025, and then it just kind of stopped. It's just been chopping along sideways for the most part. Then we do a ratio between US stocks and German stocks. US stocks, when this is going up, that means they're outperforming. Lately, we've been seeing a bit of a pullback here, but the bigger picture is that US stocks are outperforming. We'll see if this can turn and start to go back up. Then long-term rate of change charts, I usually just use these for informational purposes. We're still holding up okay here. Still doing okay with this longer-term chart as well. And then we look at bonds where we have the S&P in red, it came down on Friday, and then the long-term bond, and that was causing some concern in Friday's session. That's the 30-year bond, and that's long-term interest rates, and they've been coming down. That means interest rates are going up. And that might start to give some concern to the market. We've been watching the 10-year and it's going up, but it's not really causing any concern right now. So we want to keep an eye on this. And we see in the short term, they were actually having a tendency to go in opposite directions with the short-term correlation. Now that's starting to come back up a little bit here. Even longer term, we've been seeing the correlation start to weaken, where for quite a while they were tending to go in the same direction at the same time. So we're keeping an eye on this. Is this telling us that there's some kind of a character change? We're seeing small caps doing better. We're seeing transports doing better. Interest rates are going down. The economy seems to be doing okay. Are we going to shift over and change the character of the market where those stocks that are more economically sensitive start to outperform? And the ones that have really led the market over the last few years, maybe they start to slow down a little bit. We don't know the answer to that. We just watch it unfold day by day. And this tells us maybe something like that is beginning to happen or has been happening now for a little while. Also, right down to neutral when we look at the relationship between the QQQs and the long-term bond here. And we're still tending to decline overall with the 2-year treasury yield. So the shorter term interest rates are also coming down. And then sometimes I show this in the what to watch video, but mainly the takeaway from these charts is the market worried about inflation? Now we are coming back up a little bit here, but in a general sense, when we're declining, which we have been lately, on a short-term basis, the market's not worried about inflation or interest rates. Also, we're declining here, not worried about inflation or interest rates. Also declining here, even though we bounced back up recently. These three charts tell us that the market's not really worried about inflation or interest rates. If they were, these ratios would be going up a lot more than they have been already, not going down. Then some other markets we want to keep an eye on. Retail, not back to an all-time high yet, but it is breaking out above its 50-day moving average. And we're seeing an improvement when we do a ratio between the retail sector and the S&P after it had been declining for quite a while. And then we look at some ratios here. The top one is discretionary to staples using the weighted versions of the indexes. And now that skews things because Tesla and Amazon are in the discretionary areas. And then it's like, wait a minute, that's not really fair. If Amazon or Tesla are having good or bad days, that really impacts things differently. So then we look at an equal weight version of discretionary to staples. Not really showing any strength right now. We would like to see these going up, but they're not showing an awful lot of weakness either. We are seeing a bit of a pullback. Now, utilities have been under pressure lately, but then tech has been under pressure as well. And that's why we're seeing this ratio coming down. Also seeing a bit of a pullback with biotech, which is growth, to healthcare, which is value. Healthcare has been coming up a little bit lately. It had a really, really good November. Then we saw some profit taking. Now it possibly is starting to show a little bit of strength again. But we are seeing an improvement here with hotels to utilities. This had really been going down. This is discretionary because you don't have to stay in a hotel. I know, perish the thought. But if you have to, you can sleep in your car. where you have to have utilities. All right. You got to have heat, you got to have electricity there. And so we're seeing a bit of an improvement with this overall ratio. And then we look at what are called bellwether areas. Now, the semiconductors were okay earlier in the week. Now we're seeing a bit of a drop here. They were down over 5%, at least with the index that I follow. I follow a lot of different indexes. Some were down less than 5%, some were down more than 5%. But we saw a big drop in semiconductors where they were holding things up earlier in the week. Home builders, they like that interest rates are coming down, but then they dropped in Friday's session. And transports, they're doing pretty good here. They're actually coming on kind of strong. Retail's hanging in there fairly well, and the regional banks are also hanging in there. And then this is another apples to oranges comparison. European stocks versus American bonds. European stocks are outperforming. And then we look at some other studies here. These are the stocks in the S&P above their 200-day moving average, above 50 and going up. That's positive. Those stocks in the S&P above their 50-period moving average, above 50 and going up. Mid caps above 50 and going up. Small caps above 50 and going up. So showing fairly good strength and fairly good momentum there. And then we want to keep an eye on this. And this is the S&P to staples, toilet paper, toothpaste. Are we seeing a breakdown right now similar to what we saw at the end of 2021? We don't know that yet. We're coming down a little bit here, but it's by far not falling apart. And we've come down before and then we've come back up. This happened. We saw a real rollover in this, and then we hit the all-time high with the S&P. Then we went into the bear market of 2022. We're watching this to see if this really continues to deteriorate, then we'll get a little bit more concerned. Right now, it's looking weaker, but it's not necessarily looking like it's changing at this time. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.